Welcome to today's chorus. I'm Bernard Hickey for the Kaka. This is my daily podcast and email, newsletter and video that goes out to subscribers via my Substack called the Kaka. It's all about Aotearoa's political economy around housing, climate and poverty. Today, I wanted to look at the economy part of the politics, although they're very closely aligned, as you'll see in a moment. And to do that, I'm going to look at a couple of surveys that have come out in the last day and an opinion poll that has come out in the last couple of hours. In essence, for the last 2 years, there's been a debate about why the economy just can't seem to get going. When the government first came in, it blamed the previous government, the Labor government, for, it says, profligate spending and rising debt and rising interest rates and not being able to control the cost of living or inflation. And that was the narrative, as they say, that dominated for the first year or so. In that period, the government, particularly from November 2023 onwards and more aggressively in early 2024, froze spending on investment in pipes, in various roads, railways, school buildings, new hospital plans, a whole bunch of things, because the government was trying to restrict government spending growth and restrict government borrowing. The theory is this would allow the government to step back, to shift the debt trajectory downwards from, it says, gross debt of over 40% of GDP and getting it down towards 30%, and also reducing the size of government down from about 34% of GDP down towards that 30% mark again. Again, this is part of this overall fiscal strategy, which has been adopted by both sides of Parliament over the last 20 to 30 years of trying to get both the size of government and the size of gross debt down to around 30% of GDP. It is the North Star which dominates the government's actions in all sorts of ways. And in this case, the government chose to effectively tighten fiscal policy at the same time that the Reserve Bank had interest rates right at their highest point in nearly 20 years or so. And that is why the economy is in real strife. But until now, the government's been able to blame the previous government, and voters have, on the whole, blamed the previous government too. But that is changing. In the last few hours, we've got a poll from RNZ through Reed Research asking the direct question, who do you think is responsible for the economy being so slow at the moment? And also we have two surveys from Business New Zealand showing that not only is the economy stalled again, but that businesses themselves are starting to blame the government as well. So let's have a look at these surveys, starting with the RNZ Reed Research survey that came out this morning, which asked the question, who do voters hold most responsible for New Zealand's struggling economy? And this found that 37.6% found it was the current government that was responsible, 30.8% found it was the previous government, and there's a bunch of people who think that both of them are to blame. Fair enough. It does fall down along party lines. So if you look at who's blaming the current government, the Greens mostly, Labour and then Te Pāti Māori, although interestingly 9% or so of national voters also blame the national led government. Who's blaming the previous Labour-led government? Well, ACT and national voters, of course. Interestingly, about 6.8% of Labour voters blame the Labour government. And both equally, New Zealand First and Te Pāti Māori voters are the main characters there. And what this means is that we are now seeing one particular measure that's taken in political opinion polls, the right track, wrong track measure, showing a significant worsening in the views about the government and the economy being on the wrong track. And it certainly happened through the winter in particular. You could call it a winter of discontent, as in the June quarter, the economy went into contraction again after two quarters of some rebounding growth. And that contraction in the June quarter has really undermined the government's narrative or view that the economy is bouncing back because of the government's actions. And you can see correspondingly the right direction measure has dropped sharply. So we're now at the point where the wrong direction measure is up towards getting towards the levels seen before the 2023 election. And we also see in the actual polls on which parties people support that Labor is now head of National in this RNZ research poll. That is in tune with what we've seen with other poll results recently, the Taxpayers Union Curia poll and also the Roy Morgan poll. The Greens and New Zealand First and ACT, you can see there, are the next most popular in that order, with Te Pāti Māori at 4.1%. In the preferred PM stakes, we've now got a clear lead for Chris Hipkins over Christopher Luxon, and that's indicative too of the changing levels of support for the main parties. However, what does this mean in Parliament? Well, it really all depends on whether or not Te Pāti Māori get all of their 6 electorate seats that they currently have. Now, the party vote says they're going to get 4.1%, which means they would only get 5 of their seats, not the 6 they currently have. If they got the 5, Parliament would be completely evenly split down the middle, 50-50, so to speak, or 60-60. However, if Te Pāti Māori won all of their electorate seats, there'd be an overhang, and the grouping of Labour, Green and Te Pāti Māori would have a 1-seat majority. Very tight, obviously. Now, let's look at the next survey that's come out this morning from Business New Zealand, a survey of 130 business leaders asking them what are your top 5 concerns about the economy generally, and what are your top 5 concerns for your own business. And for the first time in this Parliament, business leaders themselves are blaming reversals of government policies after the election affecting business certainty. So obviously the abrupt repealing of Three Waters, of the RMA reforms and various other measures sort of unwinding government policies, not necessarily surprisingly, because many of these things were promised at the election, but the way it was done so abruptly, as well as that freeze in government spending at the end of 2023 and early 2024 have really riled up businesses and caused uncertainty. They're also talking about the international environment, and it's interesting to see the level of customer demand as another factor that people think is a problem for the rest of the business community. And when you look at what people were saying last year they were saying it was the high OCR and a lack of consumer demand was the problem. Now they're saying it's the government that's the biggest problem, and those reversals of policies. When you ask them about their own businesses, they are saying still it's those reversal of government policies, but secondly is level of customer demand. And when you look at some of the other areas like resource management constraints or gas costs, some of the things that the government's talking about, they are not an issue for those people in business. Now, the other survey that's come out in the last day or two is the Business New Zealand PSI survey. This is the Purchasing Managers Index survey for the services sector. So the services sector makes up more than 60% of the economy, and this survey is a companion to the PMI survey, the manufacturer's version of this survey, which asks purchasing managers, what are they seeing in terms of new orders? What are they seeing in terms of what are they doing with employment? What are they seeing with their stocks, and what are they seeing with production? So this is quite granular, detailed questions, which are less about what you think is going to happen or how you think things are going more generally. It's more a question of, what's happened to your orders. It's pretty hard to make that stuff up. And it's also a very good leading indicator of what's happening in the economy. But let's look first at the PSI survey. And that shows another fall in the last month in the contractionary territory. So that black line that you see there, that is 50. Anything that's below 50 is seen as contractionary. Anything above 50 is seen as expansionary. And what you can see there, of course, is some ups and downs in 2020 and 2021 to do with COVID. And then a slide down from mid-2022 onwards as the Reserve Bank's rate hikes started to take effect and the housing market slowed down. And then from mid to late 2023, we've seen it drop well below the line, and it stayed there. There was a rebound, but that stalled out, a sort of a dead cat bounce. And we've certainly seen that again in August. Now, in June, a couple of these surveys, the PMI and the PSI survey, were surprisingly weak, and that was one of the factors in the Reserve Bank cutting interest rates again. But in July, one of the surveys was in expansion again, and this was pointed to by the government as signs that finally the green shoots were appearing. Well, those green shoots have been burnt off in August. And you can see here from what's happened with the monthly numbers for this PCI time series that we've been in contraction for most of the last 3 years. And when you look at the PSI numbers across the regions and in different areas, all of them, anything below 50, remember, is in contraction: employment, activity, deliveries, inventories, new orders. And when you look around the country, it's all in a contraction except for Business Canterbury, and at 50.3, it's barely in expansion. And this is exceptional. So you may hear some people say, oh, well, this is what's happening all around the world, and there's not much we can do about that. We're just a cork floating on the tide. Well, actually, no. In our major trading partners and in the Anglo-American main developed economies, so when you look at the Eurozone, the UK, China, Japan, USA, and Australia, all of those are above 50. So the Eurozone, just a little bit above 50, UK, the US, Japan, 53, 54, and Australia at nearly 56. We're at 47.5. So we're different, and the reason we're different is that our monetary policy, so the official cash rate, and fiscal policy, the government's actions to restrain spending growth, have been much more contractionary, tight than the rest of the world, even though our debt is lower. And when you look at the combination of the PMI and the PSI, so this is the survey, if you grouped everything together, manufacturing and services, you can see there the yellow line drops down again and is still below the long-term average. If you look at the 3 months average and match that up with GDP growth, it's a pretty close correlation. So this says we are still in recession going into the middle months of the third quarter. Now we're going to get numbers from Stats NZ on Thursday on GDP growth in the June quarter, and what it's going to show is, according to economists, the current consensus is for a GDP contraction of about 0.4%. The Reserve Bank in its last set of forecasts forecast 0.3%, and the Reserve Bank's nowcast measure, which is a constantly updated measure, that is currently at 0.2%. So we're likely in these numbers on Thursday to go back into contraction. And that will push back against the narrative put forward by the government that the green shoots are coming and you just need to wait a little bit longer. We're almost there. Well, we're not. And it's interesting that Business New Zealand is starting to say this and release these surveys. So obviously a big supporter of the government. And they're saying that the services sector slump, they're using the word slump, persists. That's in the release that came out yesterday. And for the first time, they're pointing to government policy uncertainty as a factor in the economy's slowness. Doug Steele, who's the senior economist at the BNZ, remember this is a BNZ Business New Zealand survey, it points out there's now a very real risk that any ensuing bounce in the economy, which everyone's been expecting for 18 months, takes longer than expected to arrive. And this is becoming a real issue. The government really expected the economy would be growing quite strongly by the by-election year. And it really is like waiting for Godot. It's just not arriving. Now, the next story I think is worth mentioning. You might not have seen it if you were outside of Christchurch. Ryman Healthcare, of course, is the biggest retirement village operator in the country. And last year it announced it was stopping building new villages and was reviewing its land bank because it hasn't been able to sell all the village units that it wanted to. Remember, the retirement villages are in effect the canary in the coal mine of the housing market because they're at the end of the line. When someone is able to sell their suburban home for a good chunk of money to crystallize their capital gains, they often use some of that money to buy a retirement village unit. So if people aren't selling their suburban villas for exactly what they want to get for them, then it's their retirement villages who are not seeing their sales to those boomers who are exiting the suburbs. And it's interesting to see what happens when a market clears. Now, one of the issues for our housing market is that when there's a change in conditions, interest rates or economic activity or unemployment, you don't always necessarily see prices gap down or gap up to where they're going. They often are more likely to gap up, but they don't gap down because unlike in other countries where people who suddenly see their equity drop in their home, they are not forced to sell. Almost all people who own homes with mortgages are more than easily making the repayments. And in fact, many are ahead on repayments. And the banks are very reluctant to turf people out because they have this contractual claim on people's incomes. Unlike in other countries, parts of the United States, so-called non-recourse states, where the banks, if they see equity drop, will pull the trigger first. They'll call under mortgage, or people will send in their keys and walk out, knowing that they can move on without the bank chasing them down for regular repayments on the mortgage for the house they've just left. But in New Zealand, it's quite difficult to get a market to clear immediately like that because people don't have to sell. There are some forced sellers, obviously, marriage breakups and deceased estate sales. But until you get the market really humming and people getting what they want, then it's very difficult to get that volume through. And that's why it's worth keeping an eye on the retirement villages. Now, Ryman Healthcare last year announced because it had made a big loss, and unlike a homeowner who has a direct relationship with the bank and the bank has effectively a direct claim on their personal income, there's a personal guarantee, Ryman Healthcare is a limited liability company. So the banks, can't really chase down the executives or the people who live in these units and say, right, now you pay the mortgage. That's not how it works. And so the banks are more willing to pull the trigger than for a owner-occupier like you and me or whoever it is that owns a home. And that means that markets do clear a bit more. And so it was always interesting to see the moment when Ryman Healthcare really did pull the trigger. And yesterday in Christchurch, Ryman Healthcare put up for sale a major piece of land where they already had consent to build a whole bunch of big buildings for retirement village units. And this is the project that you can see on your screen here, the architect's drawing of one of these buildings, and it's right on Hagley Park. So there's the actual picture of this bare piece of land at the moment. It's on Park Terrace. They were going to build seven story blocks there, 6 of those, 155 apartments, 54 assisted living units, 70 dementia care units. And this was going to cost $240 million. If it had gone ahead, it would have been a major piece of economic activity in Christchurch and, of course, add to the housing supply. That's not going to happen now, and that land is now on the market. Prime piece of real estate, and it will be interesting to see what it sells for and what sort of loss Ryman Healthcare takes and whether or not you start to see a rippling write-down of land values around there because of it. And it is, interestingly, zoned for residential up to 13 stories. So you'd have to hope that some housing supply goes there. But it's one to watch this because the retirement villages have been quite effective in the last 10 years or so at building medium density and at scale that hardly anyone else can do. In fact, if you look at the last 3 or 4 years, it's been kāinga ora and Ryman Healthcare, which has been among the major builders of medium density homes in cities. It's because they're expensive. You need big chunks of land. You need real expertise in building complicated buildings. They're not like a regular whack up a standalone home on a simple piece of flat land out in the burbs. And it's one of the issues here we have, that we want more affordable homes, we want medium density homes, apartments, but there's a market failure in that the only apartments that get built generally are the ones that are for luxury buyers, so the likes of Ockham, whereas these more affordable ones, or at least smaller ones, don't get built unless there is essentially some sort of public subsidy. And with Kaingaroa no longer building new homes, and with Ryman Healthcare not building, you have to wonder where this big dollop of supply is going to come from. There is an exception, of course, with Simplicity Living, which is using its patient capital to do, and its balance sheet to do the work. There aren't enough people with big enough balance sheets to do this sort of work and solve this market failure. This is worth watching. It will be a market clearing moment of truth. There's a bigger, wider shot of this piece of land, obviously right next to Hagley Park in the middle of Christchurch. We shall see what happens there and how many units get built and when. Now, just finally, in the newspapers today, things that are hot. The New Zealand Herald leads with a story that is also a scoop at Business Desk. That is a decision by a major developer in Auckland for a project near Orewa for 1,200 homes. They have pulled their application for a consent to build those homes under the fast track consenting process. And this is a really good indication of the fundamental problem with the government's strategy of encouraging people to quickly go through the consent process and build lots of houses. It really does depend on the council involved, and particularly the water infrastructure provider, to give the okay for it. Because if you have not got the water infrastructure there, and the council will not build the roads and the bus stops and all of those things, nothing happens. And so even if the government says, we'll get rid of the red tape, it doesn't matter unless the council is really committed and has the balance sheet and the plans to invest the infrastructure to go with it. And this is the fundamental elephant in the room of our magical thinking view that we can build houses without the use of either the Crown or council balance sheets, which is what the current government and actually the previous government was trying to do. So this again is another one of these, it's portrayed as a government versus council issue. The real issue is that both sides of politics and government and councils are trying to do all of this without using their own money for infrastructure. Their idea is to get PPPs to do it, but they are too expensive, too slow, too risky from a private point of view, and too expensive from a public point of view to actually do this quickly. So we're at this strange sort of stasis where everyone says they want to do things, but nothing actually happens. And that's because decisions have been made by both parties not to use the Crown's balance sheet or council's balance sheets to borrow cheaply from pension funds who want to lend the money to invest in the infrastructure to go underneath these projects. Now, elsewhere in the newspapers, the Post is leading with the Palestine situation and a local story about dirty politics around the Wellington Council elections. There is a bit of a scoop there from Harriet Norton on cancer patients who are facing increasingly long waits. Again, this is part of the problem when you systematically underfund the health system for 20 or 30 years because you've got this sinking lid policy trying to get government spending under 30%. You end up with a shortage of staff and effectively a cascading collapse in your health system, which is where we are at the moment. Some good news there in the press. An old pub site is going to have some houses built on it. And some interesting news there I've put into as a good news story about the idea of using a second harvest to provide food for food banks. Remember, we've got 600,000 New Zealanders who are now reliant on food banks, even though our farmers supposedly produce enough food for 40 million people. And a good chunk of those people who are using food banks and their children, so we're talking upwards of 500,000 children overall who are in who have food security issues, i.e. are hungry regularly. We need to solve that problem. Elsewhere in the news, obviously, RNZ is leading with that poll, which I talked about. Newsroom has an interesting scoop from Sam Sachdeva about Chinese diplomats who have pressured a university in New Zealand over a Taiwan event, part of the longer-term story about tensions there. Business Desk has a scoop from Oliver Lewis on this cancellation of the fast track for the Orewa project. Stuff has a couple of interesting stories, but they're nowhere near the front page, and I've found them and put them into our pick and mixes that paying subscribers can see. Well, there it is. That's my chorus for Tuesday, September the 16th. It's a bit of an experiment. I'm opening this up right from the start for everyone to see. This is only possible if people subscribe and pay for the Kaka. Now, paid members of the Kaka get the full earlier version of this roundup of the news. It's called the Pick and Mixes that I try to get out earlier. And if you want to get an earlier look at that, please become a paying subscriber to support me being able to put this out into the public domain. I'm Bernard Hickey for the Kaka. It is Tuesday, September the 16th. Ka kite anō.